Anyway, how about you? What is it that you're supposed to do with all of this volatility in the stock market because you've got a 401k or an IRA? Let's bring in my good friend, Doug Flynn. He's a certified financial planner with Flynn Zito Capital Management. You can find them at flynnzito.com. Doug, good to see you. Thanks for being with us today. I've been asked by a lot of people, what are we supposed to do? They've seen a sort of a steady upswing in the market in 2009, beginning of 2010, and all of a sudden, volatility is back again, reminding us of the old days. What are you recommending to your clients?
Well, a lot of people did get to the sidelines or stopped contributing last year when the market was in turmoil, and they started going back in early this year when things seemed to settle down. But now they're questioning that again because the market is taking a little bit of a breather. But just like you mentioned, the companies that are starting back up their contributions, you also want to start back up your contributions if you've stopped. One of the single best things you can do is continue to add, compounding all those shares off your paycheck.
Should people be doing what they're doing? Should they be changing the way their 401k is allocated, that pie chart, just because we've had this volatility in the market?
I don't think so. I think that if you have the proper allocation to begin with, and of course we always talk about the one that you can check at cnnmoney.com/Ali.
Well, thank you for the promo.
If you have the right one, you're welcome. The right allocation there is so important because if you think about it, people keep acting like speculators. And you have to think like an investor. A 401k is a long-term investment program. It's not only going to be with you your entire working career, which could be decades, but also it's going to be with you for the rest of your life throughout retirement. So if you're 40 years old, you might have this money for 50 years. So you don't want to be too knee-jerk in your reactions. You want to take a long-term plan and think, if I have the right allocation, the best thing I can do is keep pummeling that money in there and try to accumulate as much as I can.
All right, so you're not concerned about what we've seen in the last month as a bit of a pullback in the market. You don't think people should be sitting here saying it's the second coming and I should take my money out?
Well, if it is the second coming and it is a 40 or 50-year time horizon that you have with your retirement money, that's exactly what you want to have happen because you're going to be adding into it while the shares get cheaper. If you could script it, how you'd want it to go is, I want the shares to be very low while I'm adding, and then I want them to be very high when I cash out. But if cashing out is decades away, you want it to be down while you're accumulating. Now, we're talking about people who have time and are putting money away on a regular basis. If you're already retired or you're close to retirement, well, the way you avoid that is you use some of the other safer investments inside the 401k plan. You don't have to use the aggressive ones, but if you are a long-term investor and you have time, this is exactly what you want to have happen. In terms of, in the near term, taking advantage of the short-term drop that we are experiencing and may continue for the rest of this year. It's going to be a volatile year. That's how you take advantage of the volatility.
Okay, so it's got to do with your time horizon. Doug, thanks for pointing out the calculator that you can use that we designed. It's at cnnmoney.com/Ali. Doug, good to see you. Doug Flynn of Flynn Zito Capital Management. Let's take a look at the headlines now. A new worldwide